Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Well, good day from Australia, everyone. It's Simon and Richard back again for the Algorithmic Advantage podcast. Simon announced with an introduction in the last podcast about what the process we're going to be involved in over numerous podcasts coming. And in this sequence of podcasts gives an opportunity for me to interview Simon and for Simon to interview me before we get into the serious part of interviewing our guests. So in this podcast, we're going to learn a bit about Simon. So Simon, welcome. Great to be here. How are things?
Thanks, Rich. I'm doing well. Looking forward to it. We've had a few technical issues today, but pushing ahead as amateur podcasters, loving it.
Lovely, Simon. All right, so do you mind if we get straight into it?
That's the best way. Let's do it.
All right. We've got a lot to cover, so we're going to try and keep this in, within a sort of an hour or so, and see how we go. So let's start introducing with a bit of a background. So Simon, can you give me a couple of minutes on your background and what got you into trading, and anything in particular that has really helped you develop your skills in the market, and who or what has been the biggest influence on your trading and investing style?
Sure thing, Rich. So my brief bio is that I studied economics and finance at university. At the time, I did quite enjoy that, but I wasn't exactly sure which way I was going to take it, what kind of career path I was interested in necessarily. When I finished uni, I did the gap year thing, and being a slow learner, it took me 2 years. I put a backpack on, spent all my money on a video camera, which back then was extremely expensive for a little digital. They were the first digital cameras. And so I worked my way around Europe, and I did summer in the Greek islands and winter snowboarding in Austria, and so on and so forth until I ran out of money. Ended up in London, as many Aussies do, and having my degree, and I'd worked in a bank while I was studying. I had a little bit of experience, and I got lucky to get a job in London on a very large trading floor, just as an assistant. But of course, there was the wow factor of the size of the floor and the people in there and what was going on, and it was I just absolutely loved it. I fell in love straight away. So I talked to a lot of smart people in there, obviously, and garnered as much advice as I could as to how I should progress in this field, and particularly in and around the trading. But I thought the first thing and best thing to do was to really upskill, and I'd learned from the risk management side of things there that those guys really knew they knew the math, they knew exactly how products worked, how they were priced. They knew a lot more detail than sort of the traders, you could say. So that quite interested me, and I ended up coming back to Australia, moving to Sydney, and got lucky to get a job in risk management at the Sydney Futures Exchange. Now, I got there just moments too late. I think it was sort of months after it was about months after they closed the pit, the trading floor, the open outcry trading system that they had prior to going electronic, which Australia did long before the US, in fact. So the paper and mess was still all over the trading floor, and it was a great sight to behold. My boss, of course, was off the floor, and he knew the whole sign language.
The blood was still on the floor.
The blood was still on the floor. There was dead bodies strewn around. It was really cool. It was sad that I missed that that era, but it does speak to the fact that I was of that era that straight away began in the electronic trading space, so to speak, and there was the old guard was changing. You either moved and adapted or died at that point.
So you were beyond the Gordon Gekko era in the Quant era.
That's right, moving into the new era, and of course we were, especially being in risk and in futures, the likes of Nick Leeson and so on were all, those stories were all fresh in our memories as well, and our training ground, but a source of endless fascination, of course. So I really learned a lot there about exactly how the markets work and how instruments are priced and what the risks are and margins and the industry as a whole, because we're dealing with regulatory issues. We're bringing new products to market in the marketplace. We need to have discussions with the regulators, with banks who would act as market makers, make sure we weren't bringing in systemic risk into the marketplace. And we engaged a lot with the other futures exchanges around the world and did similar projects with them. So, yeah, it was really that gave me a really big, I guess, step up in terms of how I thought about trading, and it influenced me a lot because, unlike a lot of, say, retail traders, I had risk management at the forefront of my mind from the beginning, and I knew that it was a dangerous game. But I was still very excited about it. So from there, my career, for the most part, remained in investment banking, stayed in risk management for a while before ultimately doing many contract and consulting roles where I would usually sit between the trading floor on one side and technology on the other, and be building software that integrated those two, or help the trading floor, whether there was new regulation that needed to be adhered to, or new systems required, or trading strategies. So between the risk and the technology and the business side, I kind of sat in the middle, which I really thought was a good place to be to again, as a background to getting more into the technology side. I could see how technology driven these things were. So I also did a number of entrepreneurial things. I didn't quite fit the corporate mold in some ways. I still liked traveling. I still liked running away from time to time. I spent a year in Spain, and I traded futures full time while I was there for myself, and really started to learn how the different styles of trading, and whether the one was shorter term, longer term, futures, options, stocks, and so on. And I did some entrepreneurial things as well, started a health business, and I really, really enjoyed that. So long story short, that kind of very diverse background, the entrepreneurial gene, the fascination with the strategy and the trading and the technology all just came together and fit perfectly. So when although I was trading all through that period because I'd been interested in it and just trading small amounts here and there along the way, by the time I got into systematic and quantitative trading, the stars all aligned for me, and I was very happy with that, and have done nothing but that since, and so my sort of world operates or revolves around either my own trading now, or still continuing to do some consulting or helping others in the industry. Worked for funds around the place, and also delivering some software that we create as well.
Well, you've dived into a very deep pool, and you've had a lot of exposure, sort of a multidisciplinary exposure, which is fantastic. So I can see where you're coming from. So obviously sort of that multidisciplinary approach, looking at things from all different angles, from risk, from different strategies, systems, methods, all of these things, that's obviously shaped your philosophical way of thinking. So let's get on to that and talk about the broader philosophy behind your trading. And so how would you describe your trading philosophy, and why do you think you can beat the markets?
So definitely being quantitative now, being systematic, first and foremost, that is my overarching philosophy in the markets, if you like, if you can say it that way. So I say that because I feel like that if I'm taking a scientific and statistical approach, then it's the right way to do it. And so long as I am taking a scientific approach, then I'm open to various avenues and various trading styles and strategies and time frames if I think that it checks out. So my philosophy in that sense then is that I'm a little bit of a jack of all trades, master of none, perhaps, where I like not necessarily being just a trend follower, as I know that you are, not necessarily just a day trader or this or that, but just overall a system trader, and I trade a range of different styles, different strategies, different time frames, and I try to take the diversification about as far as I can take it, so across all of those things, across different strategies and time frames. And one thing that I'm yet to do, so next steps would be to diversify even into different markets and contracts. So at the moment I'm primarily focused in on equities, and that's US equities, and I'd like to soon broaden that into futures and other jurisdictions as well, so Australia, for example.
You remind me a lot of Nick Raj. He's got a very broad approach to trading a lot of different system styles. Isn't particularly 100% focused on any one style, but diversified in his approach to many different styles. So I see a lot of similarities there for you.
Yeah, I mean, I guess we all know Nick around this area, so he has been, I've sort of seen from a distance what he's done here and there, and that's probably had some influence, although my primary influence has come from a mentor, having a trading mentor that trades in a similar fashion to the way that I do, runs a fund and has a lot of experience in the markets and technology, and I do think that's been a huge leg up, and I encourage everyone to find mentorships or help in whatever way they can to sort of fast track their journey, if you like.
Yeah, I know mentors are incredibly important for me. I know that we get focused on a particular area of research and we're investigating it thoroughly, but it's great to have a mentor sitting to the side who we can bounce ideas off and see if we're on the right path and see what they've experienced as we've gone down similar paths, those sort of things. So,
well, absolutely,
is that how you see mentorship?
Yeah, because that plays into another part of the philosophy, really, which is that whilst I do like being systematic and quantitative about things, there really is a human element to all of this. I do think that it takes a certain kind of person to make this work. So, I mean, I think anyone can do it, but you've got to be willing to put the work in to build up those skills and even personality types or traits that will help you succeed. So I think there's a real art plus science thing going on with trading. Because no matter how rigorous your mathematics, there's so many decisions that are made by the individual, right? So you're deciding which systems you're going to trade, how you're going to test them, how you're going to build them, which markets you're going to deploy them on, whether it's for your retirement account or a growth account, and whether you're in Australia or the US, you might have access to different markets, that kind of thing. So gotcha. I do feel like one has to balance the pure tech and coding side of this with that sort of commercial side of things, where you need to develop some intuition around what makes sense. Because when we're starting out, obviously it's all roses, and we've got a very blue sky approach. But the School of Hard Knocks teaches us that we're subject to the same human biases as everyone else. Even though we're taking a quantitative approach, we might be taking the wrong one, and or we might spend too much time on the wrong thing, or we might build a great system and then turn it off, and we shouldn't have. So we're still able to make these decisions, and there's a training ground, I think, there as well.
Perfect. So, in a nutshell, broad diversification of approach, not a one-trick pony, lots of different opportunities in the market, empirically based, science drives you, huge learning environment, mentors very important. That's your broad philosophy.
Mm-hmm.
So let's now start looking, let's bring this down now to practical application. So what kinds of trading strategies do you employ, and what's your specific objective? So, what are the markets and timeframes you trade with? How automated are you? What instruments do you trade, and how do you manage risk? All of those practical outcomes of that philosophy.
The more practical stuff. So, as I mentioned, I do primarily trade the US equities markets at the moment. And I do think that, despite the fact that that's a homogeneous group in some respects, that you can extract many different kinds of alpha out of trading a broad range of liquid US stocks. Whilst, correlations can tend to go to one at the worst time, and this kind of issue, on a day-to-day basis, obviously, the stocks don't all go up and down at the same time. So there's quite a few thousand instruments all trading there. So that's a lot of data that can be used for back testing and validation, which I also like. So used the right way, one can also use Aussie data and European data and US data, so you can bring together a lot of instruments with a lot of data to do testing that's more and more not fit and applicable to sort of broad approach across instruments. So in terms of the strategies that I trade, as I mentioned, I trade a little bit of I sort of basket things into mean reversion and trend following, if you like, and then longer and shorter terms. So I do a little bit of all of those four quadrants, if you like. The more interesting thing, of course, to talk about, because there's a lot that is talked about on the trend following side, is the mean reversion. It's the more fun bit. People are attracted to the mean reversion profile, if you like, because it's a high frequency trading strategy as compared to some longer term strategies, obviously not in an intraday basis, and you generate a lot of trades. So you've got a lot of sample size, you've got a lot to test on, and you can really benefit from the compounding of those returns. Of course, the downside of mean reversion, as we all know, is that they are subject to negative skew, and you have to invest a significant amount of time in making these strategies profitable over the longer term, if you want to avoid some of that extreme tail risk, because mean reversion is a bit of a catch a falling knife strategy where you can really give back all your gains overnight if you're not trading it the right way. So in terms of the risk management for that, first and foremost, on the stocks side of things, I like to trade a good balance of long and short systems, so that I'm trying to always be in the market with some longs and some shorts, so that if there is a sell-off, the short positions will act as something of a hedge. Yep. But secondly, and really important, is I think you need a broad range of systems. You need to be diversifying over a broad range of parameter sets, so that you can be in a position where you're constantly averaging in and averaging out of the market. So really the key is you don't want to expose too much capital at once. Sell-offs can occur very quickly and make you insolvent very quickly in this kind of approach. So the answer has to be that you really want to slice and dice things down to the minimum amount of exposure that you can at any one time, and that you're really diversifying even within the mean reversion side of things, so that you're really not exposing all of your hard-earned capital all at once.
Yeah.
I mean, any other part...
Would you say 100% automated? Are you discretionary and automated, or how would you class yourself?
Yeah, so once the systems are designed, everything's 100% automated. So we've got our own order management system built in Python that will handle all of the connectivity to the broker, handle all of the trades, the position sizing, the reporting, and reconciliation and so on. Helps with the monitoring and the risk as well. So if I'll get an email if something's gone wrong, for example. So that's really valuable. It's an advantage of the systematic trading because it frees me up to do more research, really, because I'm not operationally involved on a day-to-day basis with that.
And would you say your approach is seeking absolute returns, or are you trying to approach the returns of a benchmark? How would you classify your style?
Yeah, definitely an absolute returns person. I mean, that's really goes back to the my background in and around the industry, looking at other managers around the place and just being completely unsatisfied. Yeah. Being frustrated with the way that they approach things, but also the motivations are different. It's a very large fund. The portfolio manager's on a very large salary that he gets to keep, even if the fund goes horribly wrong. He may not even be invested in his own portfolio. And of course, there's then definitely a bias toward hiding with your peers and comparing yourself to your peers. So I just thought from the outset that I wanted to do it myself, and as you've said, validate it myself. And I guess you have to have something inside you that says, well, you can do better, right? You can. Yeah. You're sure there's a better way, so you get about doing it yourself, and then it's just hard work and put the hard yards in and go from there.
Yeah. Okay. So let's now move on to some fun stuff. Let's talk about strategy ideation or strategy creation, and also the balance we need to meet in terms of robustness. So, where do you begin with strategy creation? What's your approach, and do you have a defined approach? And then how do you avoid curve fitting and over optimization? Because as systematic traders, that's one of our big fears, is propensity in too much reliance on data where we can over optimize our models. So how do you make sure a strategy is robust enough to handle the future, which is uncertain?
So I think that in terms of both strategy creation, and it helps with not over optimizing, is I don't have an approach of letting a machine learning approach just run over data and find solutions for me. So gotcha. I start with an idea that I think has merit. Maybe it's got academic research backing it, or maybe I've seen discretionary traders successful with it, or I've had some success with it in a discretionary environment, and then I use the data to validate the idea.
So I use it first before you allow the machines to take over and test it. Absolutely.
And I think so, given my skill level, if you like, I have to do it that way. Like there's really just there's just not enough data in the stock markets, and not enough, I guess, smarts within any AI or ML approach to really make statistically valid searches, doing one pass sweep of the data and, hey, look, I found a pattern. To really qualify for a big data or a purely statistical approach, I think you need an enormous amount of data. So we do really focus on getting as much data as possible. As I said, we could use data from around the globe. Also, with shorter time frame trades, then there's a lot more trades in the sample size. But if you're relying on just that alone, I think it can fool you in 1,000 different ways. So you have to, well, you could do it that way if you were smart enough, but the reason why I take the approach that I do is to really force myself not to curve fit, if you like. So
I'm with you.
there's some hard boundaries up against which I just don't want to really peek over and get tempted by. Because having done that kind of thing in the past, I know that it tends to mislead. So I guess I often start with some of the academic side. So the whole field of behavioural finance, for example, now speaks to the human biases that are within people, and I think that drives a lot of the trading on both ends of the spectrum. On the long term, herd mentality, crowd following behaviour that leads to long term trends, and then in the short term, the overreactions and fear and greed, knee-jerk reactions that lead to mean reversion in a much shorter time frame. So I try to capitalise on both of those, if you like. But
I'm with you. So you're treating this like a science experiment where first you say, what is the edge that I'm seeking? You look at the research papers, you say, all right, behavioural finance is an opportunity where I think an edge lies. So once you've scoped that out in your mind and through your research, you then design the rules regarding that hypothesis you have, and then that's when you let the machines take over to validate or test that hypothesis. You're not allowing the machines to preempt and do all of the hard research first, without you being in control of it. Is that how you see it?
That's right. Yeah, I'm too much of a control freak. So, that's my safety precaution. So that way I get to build things up from a risk management perspective, from a logical perspective, from a scientific and academic perspective, if you like, and then I'm overlaying all of the advantages that having data and having the backtesting software and so on, all of the advantages that can bring us essentially. And I do think so. It's like it is trying to bring a very systematic approach to the testing as well, so that it's like these are the rules that we follow, and therefore we are doing something repeatable, and we can try it again the next day on another idea or whatever. So it's not always easy to be like, I know you have a very systematic process in how you review the strategies and update them and so on, but the more you do it too, then the more you develop a few tips and tricks, and that's where I think the art comes in a little bit.
Okay. So listen, now that we're getting on to the topic of edge and how you define an edge before you explicitly test whether that edge is valid, let's talk about edge. And can you comment on what you think your particular edge is with your process?
So I think that being systematic is an edge in itself. I think that many newer traders could probably get consistently profitable quicker that path than any other path if done right, especially with the right mentor. I think there's just talking about the art and the science too. I think this is a big advantage, if you like. I see it as an advantage that diverse background that I've had, and that entrepreneurial side meets technical and rigorous kind of sciencey side, allows a certain productivity to the process, so that I'm not I am less inclined to chase the wrong thing or spend time on the wrong piece of research, because I'm thinking commercially. I'm thinking about where my time gets spent. The other part of the edge, I think, in being just systematic, is that one becomes an expert more in systems than in any one particular trading style. So you can really master many styles, and that's very advantageous. It brings in a whole new level of portfolio optimization that you can do. You can mix two strategies that make 10% each, and rather than get 20%, you can get 25% if you look at the mathematics of it. So there's some just a whole extra layer of things that can go on. But apart from that, I do tend to try and focus on strategies that don't necessarily appeal to the biggest end of town, the guys trading many millions. I try to find things that might swim against the tide a little bit, or that play into the background knowledge that I have around just how the markets work and the infrastructure within the markets. I think there's just overall it's about having that blended approach, which is also part and parcel with staying healthy and happy and mindful in general, and improving yourself and constantly seeking to learn, to develop, and because you've got to be quite disciplined to exploit the systematic trading edge. It's a discipline. It doesn't mean that just because you're systematic, you're not going to be so undisciplined about it that you waste it, so to speak. So it takes a lot of hard work, and I think that being in some sense commercial about it, you've got to think about it as a business. Then you're going to plan for it properly, and you're going to study for it properly as well.
Gotcha. Look, I know that in future podcasts we're going to be going into instructional videos about how to specifically apply some of these principles we discuss here. But I know that a lot of listeners are eager to get down to the nitty-gritty, the practical. So let's look at one of your favourite strategies, mean reversion, for example. Can we dive a little deeper into this strategy, and can you give some insights into controlling risk in mean reversion? How do you measure performance? What are you looking for a good mean reverting strategy? Do you build strategies for specific regimes or that are applicable to all markets? What are some of the specific techniques and risk management methods?
Sure, Rich. As I mentioned, obviously the performance profile of mean reversion is something that a lot of traders are looking for, right? They like the high win rates. There's plenty of trades. You can generate a smoother equity curve, and the research does tend to suggest that in the shorter time frames, mean reversion is dominant, just like in the longer time frames, trend following is. And so if we're doing that short-term trading, we can really compound returns. And that's very appealing. So I guess some of the specifics, like I said, really the first part in even entertaining the idea of trading this way is you've got to have a risk management up approach. Mean reversion subject to that negative skew, those fat tails, where you can have those big givebacks. So if you at least as a starting point, you've got to look back over all of the the big sell-offs and flash crashes or bear markets or other stress test events in the markets over history, and you've got to look at how those strategies perform over that time before you do any curve fitting to avoid them. You've got to know what that looks like, and so the key is to really be prepared for anything like that, but then even anything beyond that. So it's all about the unknown unknowns, really. What shall I say? So the way that I approach that, as I said, is, I think I might have mentioned, the long short and the application of lots of parameter variations and lots of strategies working together to just carve out little bits of that with diverse sort of entries and exits, I guess, buying in and selling out at different times, and so kind of internally diversifying within mean reversion. Okay. And regarding the sort of regime approach or the regime thinking, indeed short mean reversion does tend to work well in both bull and bear markets. Long mean reversion is potentially subject to big sell-offs in bear markets. So I do tend to be very mindful of. So yes, the strategies are assessing on a daily basis the kind of market that we're in, the kind of volatility that's going on, and we are dynamically sizing positions or even really reducing risk or trading less or trading more, depending on the kind of conditions that we think, whether it's appropriate or not.
So you're getting all of this information in consistently, incrementally, and you're iteratively solving for that additional information as you go along step by step.
Yes, and not that it's overly complicated necessarily, but there are conditions that clearly, where things could get worse, and we'll just lighten up at the first hint of that. So we don't want to sort of flirt with any danger, but we're really, for the most part, as much as we can, we want to really be running that all-weather portfolio where everything is low risk enough that it can more or less survive anything. I think that's the ultimate safety valve. And then you've got to sort of maximize your returns in all the other ways and be creative about that and really utilize your capital properly.
Nice.
So the risk management is the framework. In terms of the mean reversion itself, I mean, there's just all the classic ways to measure it. As I mentioned with trend, I mean, I even bring trend into my mean reversion strategies to try and trade stocks that are in themselves strong, good, well-performing stocks.
I always love to hear that word trend, but keep going.
Yes. The rest, we're not going to make you really that happy in this interview, Rich. We're just laying the foundation for plenty of future arguments to come.
Exactly.
But that's what makes it fun. So what else can I say?
I know something you strongly agree with me on, and this is this importance of systematic trading. So let's get into that. Let's get on to something that we can fully, heartfully agree on. How do we educate investors about systematic trading? So if you were talking to an investor who didn't allocate any of their portfolio to, say, quantitative strategies, where would you suggest it could fit in their broader portfolio? So, what amount to allocate as a percent? Things to look for. What should investors be asking that manager versus other stock and commodity trading styles such as value investing? So basically, how to convince investors that this style of investing holds merit.
Yeah, and it's a subject near to my heart, especially in Australia, where I think the level of understanding around the kind of trading that we do is a lot lower. So I think education is the key. I think most of those investors out there would have no idea that the most successful hedge funds of all time have been quantitative funds. And of course, you think of Jim Simon's Renaissance fund earning 66% per annum until it got so big that they had to shut it down to new investors. I recently read the book written about Jim Simon's, which was quite a good read.
That was a Zuckerman book.
It was, right? I think, yes.
Yeah.
Yeah. So I think it's education. I think that there's probably a little bit of hesitation there because of really that people like to use big words and they think they're sounding smart if they confuse people with the tech side of quantitative trading, and then people assume perhaps that it's a bit of a black box and they don't really know what's going on in there. But I think of regular funds as more of a black box. Like with my trading, you know exactly what you're going to get. Here are the rules. They're written on the pack. You're going to get what's in the, it's going to...
Yeah.
what am I trying to say? It does what it says on the package.
It's fully transparent. Yeah.
Yeah, it really is clear. And then you know that those rules are the rules that are going to be adhered to, and they're the rules that have been back-tested on, and you can view the back-test results. When if I was giving my money to another fund manager, and look, I've got a deep respect for any kind of fund, really. Like there's great skill in managing money in any way you choose to do it, but I see that as more of a black box where I don't know what exactly they're going to do. I don't know whether they're going to wake up on the wrong side of the bed one morning, or how their team works together, or whether they're going to change plan halfway through, or come up with better ideas and just change their strategies. So the fact that from our perspective we can be clear about that, and then show a back test, and we can have some at least scientific merit to why we've chosen a particular strategy, because we've actually applied those rules on data in many different ways, and we've had it validated the best way that we can. I mean, the other thing is that technology just gives us tools that we'd be mad not to use. I mean, the machines can process vastly more data and make more decisions and trade more strategies than I could as a portfolio manager on my own. So there's a lot of there's just a lot more heavy lifting that can be done. And for example, in trade, you've got a cat there, Rich.
I've got a cat there who's getting a bit hungry.
Jumping up on the desk soon.
I'm going to try and remove the cat now.
So then there's, the fact that you can trade all of those non-correlated systems. So you can diversify over markets and timeframes and geographies, and create some really incredibly consistent return profiles that you just wouldn't have the bandwidth to do any other way. So I think with a bit of an education, which hopefully this podcast could help with, then I think that we can raise the profile of this kind of investing, and the amount of diversification that can be done with it, which, as has been said, is really the only free lunch in the market, right? Is that diversification. So that's something that we've really we can specialise in. So I do think a small allocation to this makes a lot of sense, particularly when we're in an uncertain time, we're in an inflationary period now, we're in regime shift, things are changing. So when there's uncertain times ahead, you want to be less predictive and less confident in your predictive power, I think, and rest more in your non-predictive strategies, and especially those that are designed to attempt to make profit in crises as well, so that you've got not just a fighting chance, but you could really come out on top when there are sort of dramatic shifts or sell-offs and that kind of thing. So as for what should people be asking their managers, they should be asking them those questions like, well, how do you know this works? You just couldn't even ask that question for most usually. So I think that with a bit of education, we'll see the continued uptake of this kind of investing.
Gotcha, Simon. All right. Well, I think I put you through the hoops with a number of the deep questions, but now it gets to the easier part. This is where we do some quick fire questions. I'll see how you go. So first one, personal habits that you think have contributed to your success, your biggest strengths.
I think for me it's been persistence. That's just the reality of how long I've put into it, and how I've continued on with it, even though there have been so many just throwing things at the cat. All right, that's the cat's welcome on the show, Rich. Probably break the YouTube audience will love it. Cat videos. That's where we'll go if all of this doesn't go well. We've got a backup plan.
I've got a dysfunctional household. Lots of dogs, lots of cats. Yeah, it's a menagerie.
I've nearly given up many times. So it's been a long-term endeavour where I've just sort of persisted with it. I think marrying the art with the science is valuable. So not only just is it good to invest in learning to code and so on, but listening to others, learning from the experts, reading as much as you can. But the podcasts that are already out there are fantastic. They've been a great learning curve, thing to learn from. So, yeah, I think for me it's the discipline and the and persistence.
And so, if you could give one piece of advice to a youthful investor who's sort of entering the market for the first time, what would that be?
Start a cafe.
I hear this lack of confidence.
It's a tough road, I think, and you could get lucky, but it took me a long time. And you've really carved out your work for you because you're competing. Have you ever heard it said when you start trading, it's not like there's a training ground, right? You're immediately competing in the market with
thrown into the deep pool.
All of the best. So it's really very arrogant of us to think that that's going to be easy. So
except that you're going to be fish food for the first few years of your life.
Yes, I think so. Right, and then you've got till you learn what the sharks are doing, and take it from there. But in all seriousness, I would say, for a start, take a quantitative approach. Learn about the software and the data, and just start with some simple systems. And from there, I think that's a really good platform to work out how the markets work from a much more academic and scientific way than paying someone for a flashy trading course because the YouTube ad had him in a green Lambo.
Tell me, as far as things like computer programming, which way is the best way to go in the systematic path? Is there any preference, like Python, that sort of thing?
I think Python. I think Python's probably the way to go to get a good overall coding skill set that's going to be applicable to a lot of different things that you do, and it's fairly easy to pick up. Not that I'm a coder really, but I think that's really the way to go, unless you really are. So if you're not already studying computer science and you're not learning C and C++ and whatever, I think Java's a fantastic starting point.
Okay, so look, I can hear from what we have discussed that you're a fairly humble person. So let's talk about humility as a final question. So. How humble do you have to be in trading these markets? How important is that?
Yeah, I think it's very important, to be honest. If you are humble enough at the outset, and like I said, I thought I could beat the market for many years. I mean, not just beat the market. I thought I was going to make good couple of 100% a year consistently without any down days. Especially when I was back working at the SFE, watching the charts and watching what other people were doing. But I think there'd be a really valuable starting point that if your expectations are tempered, you'll waste less time if you're not shooting for the moon, and go in and do something that's consistent and basic and simple, and then keep building on that. That's a win. If you got that, that's a win. You'll slash your time to success, I think.
Yeah, no, definitely. So look, that about wraps it up from me. Is there anything I've missed that you'd like to discuss?
Oh, I think we're good, Rich. Yeah, I've probably talked too much anyway, so.
No,
I'm
I
happy
think
with
it's
that.
been very enlightening. I see your approach now and your philosophy. It gives me a lot of ammunition in coming debates, so
yes.
That's great. So look, what I'll do, Simon, is I'm handing it back to you and saying, goodbye from me for you to take on, you close the show.
All right, shall do. Well, really, that's it then, guys. Well, thank you very much. Thanks to Rich. And if you want to be in touch, of course, just jump on our website, thealgorithmicadvantage.com, and we'll see you on the next one.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.